The principles for responsible investment is, I guess, three things. It's one, it's a set of principles, 6 principles that create sort of a framework to help investors develop a responsible investment approach. The second thing is it's a network of individuals who are sort of the leading experts in responsible investment. Many have been working on it for a decade. And the third thing it is a framework for collective action, helping investors work together to achieve their objectives.
And what are the issues that are driving momentum right now?
Specifically in the context of private equity, I think that there's probably, you can look at that answer from, or that question from 2 perspectives. One from what's driving it on the LP side, and one what's driving it on the GP side. On the LP side, I think a lot of investors are saying, okay, well, we've got an approach to responsible investment where fundamentally we believe that environmental, social, and governance issues can impact success of our investments in public equities. In private equity, the underlying asset is still a company as it is, so why wouldn't those same risks apply? We think that they probably do, so therefore we want to sort of apply what we've learned in public equities to private equity. And I think from the GP side, I think GPs are recognizing increasingly that if operational performance is an important part of the value that they're creating within companies, the closer you get to managing operational performance, the more some non-financial issues, including environmental and social and governance issues, can matter. And
in terms of the due diligence process that LPs are carrying out right now, how much are PRIs weighing in these processes?
I think it's probably mixed. I would say I think it's fair to say that most LPs have not yet, and I'm speaking about for instance, the PRI's LPs who are signatories to the PRI. I think it's probably fair to say that most of them haven't yet integrated ESG into their due diligence processes. I think that's something that will happen over time. I think like a lot of GPs, a lot of LPs have been really focused on the portfolio for the last year or so. And also, I think what you'll see is LPs will start to act around this when fundraising returns. I think the first thing that a lot of LPs will do is integrate ESG into the formal due diligence questionnaire. If there isn't a lot of fundraising that's happening at the moment, then the motivation to do that might not be, or the pressure to do that might not be there yet.
And what about in terms of the monitoring? Is there a disconnect between the way LPs envision their commitment, support of ESGs and PRIs, and the commitment on the GP side?
I think that probably at the moment there isn't too much of a gap practically in terms of what is being asked and what is being responded, but I think probably conceptually that there may be still a gap. I think where LPs eventually see themselves getting and wanting to see their GPs get to might be a little bit further than where GPs expect to get encouraged to go. But I think it's important to, when thinking about these issues, to reflect the fact that it's not just LPs that are driving this. I think GPs have got 2 clients, people who give them money and who they try and return a strong investment return to, but also the client at the end of the process who they're selling companies to. So I think increasingly GPs who are looking at, particularly if trade buyers are one of the main exit routes these days, the degree to which a public company that may be a strategic buyer for one of your companies has ESG risks on their risk register, that's the kind of signal that I'd expect a GP to pick up on and say, well, maybe this is something that we should be looking at in terms of our management of this company too.
And what about for funds of funds? How do things work for funds of funds?
Yeah, I think it's interesting. In terms of the PRI signatory base, obviously there's, I think there's almost 200 asset owners, so pension funds, insurance companies who own assets, many of whom, if not most of whom, invest in private equity. We've got a number of signatories who are general partners. I think there's sort of 30 or so now who are signatories. But that's a drop in the ocean, really, of what there is. But on the fund-of-funds side, we've got sort of 6 or 7 of the biggest fund-of-funds that are signatories. And I think they're in an interesting position because, on the one hand, it's a service that they can provide to their own investors, oftentimes who are asset owners, saying, okay, well, we can handle ESG issues for you in terms of engagement with the underlying general partners. But at the same time, I think a fund-of-fund is a bit stuck in the middle where you've got, on the one hand, perhaps a bunch of your investors, not all of whom care about these issues in the same way. And on the other hand, GPs, not all of whom are as willing to talk with you about these issues. So managing those sort of different diverse groups, I think, is an interesting challenge for fund-of-funds. And I think the other question also becomes, do fund of funds try and differentiate themselves based on being able to provide these services to investors?
And if we have so many signatories right now to PRIs, why is it then that the numbers of GPs that are signing is not larger?
I think that two principal reasons that I've heard GPs tell me. The first is while we may be very supportive of what the PRI is now, do we know where it's going in the future? While we can certainly picture ourselves signing on to the PRI now, if it changes, it would be quite embarrassing to have to remove oneself as a signatory if one doesn't like the future direction. And I think that's still a lingering concern about, is this a commercial initiative where you're looking really about improved returns, or is there a bit of a public policy angle to this as well? And I think it's not surprising to hear people express those concerns. I think the second reason is if you take a look at the principles, the first three are really focused on the investment manager, the investment decision-making process itself. The final three, where it's really promoting collective action and sort of spreading the word, so to speak, is most easily understood from an asset owner perspective. If I'm KKR, and one of that second set of three principles is you should work to help others raise their awareness around ESG issues. Why should I, as KKR, help my competitors get any better at this if I think it's actually fundamental to value creation? So I think that there's some of the PRIs is more applicable if you just think about it in terms of asset owners than at some investment manager levels.
And if we get down to the application of PRIs on the GP side, I've often heard that it's interesting and it's necessary from the exit point of view because you want to make sure that you get the most out of your asset. Do you think we'll start seeing also increased interest in the issue at the sourcing level?
In terms of deal sourcing?
Yeah.
It's an interesting question. I think we're already hearing from some general partners how they think about that. For instance, there's one large UK-based GP who works internationally who has said, particularly in emerging markets now, they want to avoid bad deals coming to them. It's a lot harder to get good information on companies in some emerging markets than it is in the UK or Germany or the US. So to avoid getting 4 months into a due diligence process and turning up things that actually are going to stop you making that investment, if you've got a reputation for a keen eye on this stuff, maybe some of the bad deals won't come to you, which I think is interesting. I think there's also a perspective when seen from just looking at quality of management. One of the things that all private equity houses look for is what's the quality of the team that we're buying into. It's not just a company, it's a management team. A lot of public investors in public equities look at management of ESG issues as a proxy for good management. The more you know about your company, including its performance on non-financial issues, all things being equal, maybe the better manager you are and the better run that company is. So I think that's another way that it could come into it.
But if value creation is then in improving on ESGs, how do you balance things out if you're already looking for ESGs at the sourcing level?
Certainly, I think one of the things that excites a lot of limited partners, or to say big asset owners who may invest in public equities and in private equity, is in public equity, you can't necessarily change things that you see that are bad. The relationship, the influence that an owner of a company has on a company's management is a function of how much rights shareholders have, which in some jurisdictions is not a lot, and two, how much of the company you own, which oftentimes is under 1%, maybe 0.1%. On the private equity side, here's a business model where if something is broken, you can fix it quite quickly. And I think that's something which a lot of LPs are quite keen about private equity, seeing it as almost, in some respects, a more sustainable model for ownership.
And if we were to summarize what we can expect in the months to come from PRI issues, what would you say that we're likely to see?
I think you can expect to see the last 2 years sort of is the period of time when the PRI has been really focused on private equity as an asset class. There's been a rapid growth in levels of awareness and interest. And I think you can expect to see a little bit of tempering off on that. I think people understand that this is something that they've got to look at, but at the same time, to go from awareness to action, it makes sense to settle down